2025, and there's a lot happening. Natural gas, oil, cocoa, gasoline, corn, outperforming stocks right now. Something I want to obviously talk to the channel on here, talk to the commodity guys. These guys know a lot about that. We can kind of take you through how to handle that, how to position yourself, and just kind of see how we want to look at the markets going forward. Kevin's got a busy morning this morning, so I want to get to Kevin immediately. Something we talked about, Kevin, the other day. There was somebody who wrote in and on our YouTube channel, and they mentioned, "Hey, so if we got oil going up, how do we position ourselves to not lose money from inflationary times?" Like so, basically, like the normal average family, the normal average American at their home, trying to figure out how to navigate inflation. Do you have any advice for this? I was curious because I was like, this is a great topic that really touches kind of everybody, but because we're always talking about trading, we don't really talk about this too much. So, do you have any thoughts?
Yeah, no, I mean, like it is, it kind of depends on how much cash that you have available, right? And what you're able to leverage. But there's definitely opportunities for you to be able to buy things in bulk if possible and be able to store it. I don't know if you kind of want to go down that route, but if you buy like a quarter cow or half cow, right, you can kind of stave off any type of inflationary pressures that you might see from beef prices. I know that was a big thing for me. Like I started doing that stuff and kind of getting deep freezers and stuff like that before COVID. And then when COVID hit, like everything was, everybody was freaking out, and it was cool because not wasn't cool, right, for everybody else, but like I didn't have to really stress about anything. So it's like anytime that you have any type of free cash that's available, right? We always talk about investing, but I think if you invest for your own well-being, even if it's on a minimal scale, go to Dollar Tree or something like that, buy something. It definitely is able to kind of like help you out. Like what's actually very interesting too, and then we'll talk about some of the market stuff here, is like there's a lot people don't actually understand or haven't looked at the resources that are available to them within their community. So like I'm a really big advocate on something called a community supported agricultural group, right, or it's a CSA. And actually you can go on the USDA website and look for CSAs in your neighborhood, right? These are like local farmers, or like if you sometimes you'll see like a local garden that's in your neighborhood or something like that, or even if you go to a flea market, you may get into one. But community supported agricultural programs, a lot of them have farms that are a part of their program, and what you can do is you can buy a share or a quarter share or half a share within this farm pool, right? And they usually have them during seasons. So there'll be like a summer season, winter season, a fall season, blah, blah, blah. And they'll go out for like 15 weeks. So you put the money up front, that money up front is to be able to help out somebody that's farming, right? Because the biggest thing for a farmer is the upfront costs in order to keep operations going. So this community supported agricultural programs, you put money up front, and then the payback of that is not a return when it comes to actual monetary, right? But the payback is that you can get like on a weekly basis or every 2 weeks, you can get a portion of the crops that are harvested, right? And then the share, the amount of money that you put in and what you buy, it'll scale out to whatever your family size is, right? Like if it's just you, maybe you do like a quarter share. If it's you and three others in your family, you get a half share or what have you. And a lot of times you can also look for other individuals that want to split them. And the reason why I kind of bring that up is because the return on investment is like literally tenfold. If you know how to process food right, and if you actually are very diligent on cooking stuff at your own house, I think that's one of the easiest ways. And the reason why I bring that up too, a lot of times those community supported agricultural programs also have connections to things that are very volatile in price, like eggs. I have not paid over $4 for eggs in the last $5 now for eggs in the last 4 years, 5 years, right? For a dozen, no matter what happens. And right now, if you kind of look at prices, if you go to Walmart.com, eggs are going for like $8.99 a dozen right now. It's actually remarkable. We've seen almost a 60% increase in prices in a matter of a month and a half because of the avian flu and things of that nature. But kind of going back and saying, hey, there's actually opportunities where you can find somebody that's able to supply that for you at a stable price, because if you cut out the middleman, a lot of times you're buying agricultural products, you get a pretty decent discount and a lot better quality. It doesn't, a lot of them don't use like, certain pesticides and A lot of it's organic, depending on who it is. So that'll be my little nugget for today. Community supported agricultural programs. You can look at them, just look at them in your neighborhood, and then look. People are going to be like, well, I live in the city. I live in the heart of Chicago. Dude, there's a bunch of them around. You can find them in the city. You can find them in the suburbs. You can find them in rural areas. Very, very under something that's very under the radar, but something that allows you to scale. Like, and then I want to get to the markets here. For instance, I have one that's very close to me, and I put up around, it depends on the season, right? But let's say it's the summer season. I might put up $400 for a half a share, which a half a share gets you a full bushel. So like a bushel is like it's like it's unfortunate. I can't really like quantify it, but because we talk about bushels and corn stuff, but a bushel is literally enough to feed a family of 4 comfortably every single day, pretty much breakfast, lunch, and dinner. And it's usually going to be like the veggies, right? And you can get eggs with it. You could buy meat. Some of them do have meat. But it's more than enough. And so if you get those bushels, so $400 I spend, but let's say the program's going over a 20-week period, that's a pretty decent ROI on the amount of food. I mean, every bushel that I would receive, if I went to the store and actually did that, I probably would receive about $85 to almost $90 worth of produce every single week. So $90 worth of produce every single week, multiply that by 20 weeks, you do the math. Actually, it pretty much pays for itself over a matter of 4 weeks, 5 weeks. But that's the dividends that you receive because you're able to kind of put this money up earlier. So last thing to capstone this, you get a food, get a vacuum sealer, get vacuum sealer bags. You can get those off like Temu. You can go to Outdoor World or whatever to go get those bad boys. Buy 2 deep freezers for $250. That's going to be more than enough. Very low energy consumption for that. Vacuum seal what you got. Dehydrate what you have. Pickle, if you're into pickling and fermenting, do that, and then like stock up. And then over time, you'll see how these things kind of add up. So that's a way to kind of work with inflation, and you can do that on a smaller budget as well, so that's that.
No, that's great. Honestly, I just think it is timely. For me being a crazy inflationist type, I've always been like picking up, a little bit of gold here and there, and silver over many, many years. There's obviously ways to do it, and I think Kevin just coming in here and saying what he said is also very valuable. So let's kind of get to your report, Kevin. So what did you highlight in Q1? I'm going to leave that if you guys are on YouTube, you'll be able to see this in the comments. So you're highlighting Q1 2025.
Yeah.
And everybody wants to know, what do you think in Q1 2025?
Hey, you know what I do have to say, though? I appreciate the support for those that do. I know a couple of guys that watch this stuff and gals that watch this religiously, and they send me DMs and stuff. So like, one, we appreciate your support just in general. And I know that you do see really added value. I mean, we get tagged and stuff almost every week that somebody hit a banger one way or another, or they have their own insights and they kind of maybe counteract or counter our arguments or what have you, but it's a really healthy discussion. I think this community is just doing a phenomenal job just in general here. So I do appreciate that support. I mean, it's got like 56 likes just on Twitter alone, 13,000 views. That's actually pretty good for me. But look, that report really just kind of highlights, like, I'm not a real big fan of like what's on the radar for 2025, just in general, right? Like, we see that markets can be very dynamic. I think the biggest example of that is starting off last year, completely different notion about what was going to happen with the economy. Even myself, I thought we would see a little bit more of a slowdown and less resiliency than we actually did. And dynamics change. And so I'm not really a fan of those, analysts that come on and they say, hey, here's my price target for the S&P 500 at the end of the year. Like, hey, there's no way. You're just throwing darts at a board at this point to be able to do so, especially with this new administration that's going to be coming. I mean, there's going to be a lot of changes taking place, good and bad, right? And a lot of that's going to create a little bit of volatility, maybe a little bit of uncertainty when it comes to Fed policy. So I like to look at things on a quarter by quarter basis. That's 3 months, right? And so you kind of get a little bit more of a better picture. The first part of the report really just tries to set the stage of what's happening with the labor market. I don't think the market's really going to get concerned about the labor market until we see about 4.5% to 4.6% unemployment rate. I don't know if we're going to be able to hit that mark at the end of Q1. I think that's more of a Q2 story for right now. And the reason for that is another thing that I highlighted is that the Philly Fed, they have this, they basically have a model that tries to see what the corrections are going to be for final estimates for the non-farm payrolls, right? And we saw this massive adjustment in August of last year. Remember, everybody was freaking out. Oh man, like we had 818,000 fake jobs. Remember that number, right? So that was actually a preliminary number, and we're going to get the final number in the February, the January print, which will be reported in February, right? First week of February. And the Philly Fed's basically saying, based on their model, hold on, because you're going to see a lot more aggressive readjustments when it comes to the non-farm payroll numbers, especially for last year. That actually has a little bit of an impact when it comes to doing seasonal adjustments and things of that nature. When you're looking at non-farm payrolls at first, they're estimates that are coming from each and every state. This is not the government, the federal government that's making up these numbers. These numbers are literally coming from the states, and they're basing that on estimates from employment claims and things of that nature, right? And so it's a very small subset. And then there's a broader model that tries to say, okay, unemployment rate's at 4.5%, or we added 300,000 jobs for the month of XYZ, right? And then when we have these massive revisions, that's because the census data is now has been collected, right? And so now that revision in February is going to be around 95% of the total data set that's out there. So you're going to get these recorrections. In the report, you can see which states, I took a screenshot of it, which states are going to see the massive adjustments. What's actually funny, side note, notice the states that are actually seeing the massive adjustments. A lot of people blame some of these blue states for overstating the jobs, but if you kind of look at the data, that's actually not the case. Some of these under the radar type of states are actually the ones that are seeing the most, the biggest revisions, which I find very interesting. But what's also going to happen is this readjustment when it comes to the labor participation pool numbers that are going to be out there. Once again, the seasonal adjustments, year-over-year prints, and things of that nature. So I think you have a 4.5%, potentially a 4.5% unemployment rate that we could see in the month of in Q2. But kind of setting the framework for what's happening or what has already happened when it comes to the labor market. Moving on from there, and then I'll kick it back because I don't want to hog this thing here. But moving on from there, I highlight a couple of different areas, and there's going to be a part 2 for this. Most likely, maybe next week. I got to go to a funeral this weekend, unfortunately, so I'm going to try to write a couple of this stuff on the plane. But if not, I'll publish it mostly midweek next week. But talked about LNG. I don't have to explain LNG to you guys. Those that watch this every single week, you know my thoughts about this. But I think this year, last year, it was LNG exports, right? And so that was really where the Cheniere Energies of the world, which Cheniere is still a great company, was really able to thrive. And you can continue to see that they, did see a nice little pullback and continue to move higher. But I think now for 2025, and if you're looking at Q1, I think the story is going to be more of the infrastructure plays for LNG, right? So you're going to get the expedited approvals when it comes to regasification facilities, when it comes to export facilities, things of that nature. Pipelines. So who's actually going to be the beneficiaries of that and who could see a bump? So I'm looking at some of the infrastructure plays that are out there. So Baker Hughes is one of them that has certain turbines for liquefied natural gas development out there. Other names, GLNG, which is another ticker symbol. So they actually have tankers. So the tankers side of the equation, you're starting to see more tankers, LNG tankers hitting the market, but it's still going to take a very long time. And there's still going to be a fair amount of demand that comes out of the EU. So they're going to be another one. GLNG is the ticker. They've had a phenomenal run, and it can continue to probably see some more movement to the upside. Total Energies is another stock. I call out Chevron, Exxon, not the bigger, they have exposure, yes, but there's, some of they have a very diversified portfolio. Let's just say that, right? So you could have really good strength in LNG business, but chemicals are not doing that great. Exxon, Chevron, Valero, for that matter, they're not going to really do that great. And then I call out Honeywell, which I think is actually a very interesting one. Somebody commented on that. So this is going to be a very small portion of Honeywell's business. So they did acquire a company that has LNG exposure. If you look at the acquisition and it's going to be only about 5% of their total revenue, right? So not a major player, but they are an infrastructure play to be made here. So Honeywell could be another one there. So kind of talk about that, weighing the pros, cons here, and really saying, hey, the infrastructure side, the infrastructure play is probably going to be the bigger play in Q1 rather than just the pure Cheniere energy, even though Cheniere, I believe, can still do really well. Let me get through some of these other ones here. Copper. So I highlight the copper market. Two things, and I sent you a chart, two things to kind of note. Last year, there was this huge copper phase at the beginning and pretty much at the middle of the year, but we did see it fade. And you and I actually talked about it literally when it was hitting the peak. We were talking about, hey, there's going to be more supply that's going to be coming online in the second half of the year. And what has actually happened? Supply has hit in the second half of the year. There's two reasons for that. Smelting operations in China has actually expanded. And so you're seeing you're seeing their production rates in China actually rip to the upside here. You also had some other smelting operations come online for the better half of the year. You had some exporting activity that was also taking place, new permits that were taking place. So we actually had refined copper supplies are actually in a glut right now. We actually have a surplus of refined copper. What we have as a deficit is copper ore, okay? And there's a situation that's kind of taking place right now is that the smelters are actually pulling back on production, except for China, because the spread between copper ore and what they can smelt and sell it for is starting to get squeezed to all high hell, right? Which will then actually provide maybe a little bit of a pullback when it comes to refined supply over time. But we have to basically work through that refined or finished copper supply or surplus before we actually see positive price advances for copper in general. There's going to be a China story there. China actually became a net exporter of copper, which is something that's kind of rare for them, has actually became a net exporter for now because once again, they had so much supply that was on hand. And you can actually see in the Shanghai inventory, and you actually have it here, SHFE is the Shanghai inventory levels that you see for copper. Those are actually starting to move down at a rapid pace. And if you kind of look at what the inventory levels were sitting at in June and July of last year to where we were at in December, it was almost darn near 70 to 75% drawdown in inventory. So eventually they're going to have to backfill. They're going to work through their refined copper supply, export as much as they possibly can because they don't have domestic demand. That's been the problem too. Until domestic consumption actually increases in China for copper, they're going to continue to be an exporter, and that's not really what you want to see. China is 55% of the global supply out there for copper or consumption for copper is China. So you want to see China turn into a net importer again. You want to see those domestic consumption numbers starting to go up here a little bit more. And that's where you're going to see prices move to the upside when it comes to copper here. I have a resistance level sitting at around $4.75, 470, 475. Looking at that 100-week moving average and the 200-week moving average as an area of support, those have converged pretty much at the same levels. Sitting at $4 around there, rough 10 cents plus or minus. And if we get a break below $4, looking at 370 as your area of support here. But I think towards the latter half of the quarter, copper can be that pop to the upside here. I know I'm taking it, but let me just. Silver, same thing. The narrative last year saw a lot of retail traders getting in. Silver is a part of pretty much 90 to 95% of all electronics. The AI story definitely carried a little bit of weight. It's also an inflationary hedge as well. Catch-up trade when it came to gold. Higher beta trade when it comes to gold. It's faded here a little bit, kind of flagging out. But you need that China story to kind of remain, in my opinion, for silver to really put higher. But it is actually hitting some pretty decent areas of support here. You got maybe another $3 to the down, actually $5 to the downside after the push today, where you can see an area of support. You have it highlighted there before we push higher. I think if you push above $32 and you have the volume exceeding the 10-week moving average by about 20 to 25%. I think that would be your indication or your power candle on the volume side to say, hey, there's something that's structurally good here. And any fundamental breakdown in silver, in my opinion, would be a global slowdown narrative in place. And then the last thing is kind of talking about the crude markets. Not surprised what we saw at the latter half of last year. The fundamental picture doesn't look that great, in my opinion. I think in 2025, just in general, the fundamental picture is not that great. But once again, let's go back and look at Q1. And Q1 2025, I think, is your best bet. Let me not say it like that. Gives you the best environment, in my opinion, for prices to advance. But you have a ceiling, in my opinion, sitting at $75. this market's still open here today, and obviously we still got a very long time to go, but you can actually see that in the price action on an intraday basis. What did we fade at today for crude oil? $74.99. I feel like it's going to be very hard to break through that $75 level. I think there's a range between 67 and 75, a breakdown below 65 for the year. I think you could probably get down to the mid 50s, but anything that's going to be a sustainable push to the upside for crude will be met with OPEC supply hitting the market. I bet. So like that's one thing to just be mindful of. They're going to supply the market as much as they can see, stabilize prices. And you might be seeing that already here, actually. When it comes to Saudi Arabia, they actually just increased their prices for Asia, for the Asia markets this morning, well, last night. This morning, basically, right? That's the first time they've done that in 3 months. So there might be something that is there. And if you actually do get prices to advance be above $80, $85, I think OPEC actually makes a move, brings production online, and tries to, I would keep the market supplied. Let's just say that. I find it very difficult for us to get a $100 rip, or us to hit $100 and sustain $100 or even $90 for crude right now. But I think for Q1, what you're going to see over the next 3 weeks is the utilization rates are going to pretty much collapse. I would say they're going to collapse. You're going to have maintenance season that's taking place. You have an Arctic blast that's taking place right now, which is another reason why you're seeing prices move to the upside. Concerns that pipelines might be impacted. The Bakken region could actually have some issues when it comes to extraction and transportation of fuel. You have the Midwest, especially when you're looking at Kentucky, that could actually have an impact when it comes to gasoline movement. When you're talking about on transport by road, right? Which could have an impact, right, when it comes to prices, and then potentially seeing snowstorms within Texas. And we already know what that's going to entail. Those things, like they freak out anytime they have any type of snow out there. That's going to also have an impact. So I think you're seeing a nice little pop to the upside. What I will say for the bulls, though, you have seen open interest actually increase over the last 4 weeks, but I get a little bit cautious because that open interest increasing has been accompanied by low volume, and actually each and every week that we've seen price advances, volume has gotten weaker and weaker. And if you're a commodity trader or any type of trader, but especially when you're looking at commodities, open interest going up with prices going up means that there's bullish positioning taking place. But if volume's light, that's also where you can move prices higher, right? If liquidity is kind of thin. So I look at 75 being at that area of resistance. Let's see if we get a close above 75 this week. And I have like a price range there for crude. So that's kind of my thing. My next one, I'm going to be talking about aluminum prices. Aluminum prices have skyrocketed. Alumina has also skyrocketed when you're looking at those prices. And I think that there's going to be a couple of stocks that you should keep on your radar, like Alcoa, which is the third biggest aluminum producer, extractor, and exporter, seller of aluminum or finished aluminum products. And then we may have actually a structural deficit when it comes to recycled aluminum here in the United States. So I'll be talking about that. I got a couple other things that I'm going to be talking about too. So that's what I got. Appreciate it. What are you guys' thoughts? You guys have any comments or anything of that nature? I appreciate you giving me the floor there.
Of course, man. I love it. And yeah, definitely check out Kevin's report. If you're on Twitter, it's obviously all over all of our pages. I retweeted it this morning. I'll be sharing it on the Substack later. If you're on YouTube, the only way we can talk to you guys is through YouTube. So I sent you guys all a link on YouTube. Also, sorry, something happened with Twitter earlier. I put the YouTube link up so people can just get on there if you need to. Looks like Twitter is up now as well. So, but yeah, just looking through this, Kevin, and I also like what you said earlier. Markets are dynamic. People making big 2025 predictions. Even I make jokes about big picture for 2025. It'll be my title, and I'll be like, but predictions are all BS, and that's the truth. Like a lot of predictions are BS because we don't know the whole year ahead. But understanding what the dynamics are quarter to quarter is kind of what we do. Like that's what we do well. And as traders, I think that's how you really have to look at it. Whatever your time frame is, if it's day to day, try to figure that out. Very hard to do that day to day, but just try to figure that out the best you can, month to month, week over week, whatever it is, whatever your time frame, do that. And I like the way Kevin did that earlier. Just looking at what you're saying, Kevin, is it's very interesting because I think you're right. The dynamics right now, and also it kind of goes with seasonality too. The dynamics for Q1 every single year are usually the best for oil, natural gas, and so on. So if we could see that kind of move up here, And I also like the way we're thinking of the price levels. Above 75, more bullish upside. Hitting 75, maybe it stops there. So once again, these are ideas you have. You have a long-term time frame. Maybe you'd hold on to this position here. You have a short-term time frame. You're trading a range. Maybe you'd want to get out here. So Kevin really highlighted all those things, and that's what I love about what Kevin does, which is that's all tradable. Not saying he's giving advice, but just actions that you guys can take as traders to kind of look out there and look for specific price levels. Sam, do you have anything to add?
I do got to jump here, and I'll jump back on here in about 10 minutes. I do
Yeah,
appreciate
cool.
it. I'll
Yeah,
be
no
right
problem. I'll see you in a second. Sam, do you got any thoughts on all these charts that you pulled up here? I saw you actually marked out the copper one pretty well, and also we should talk a little bit about Sam made a really good report last week about copper, um, possibly looking at a bottom starting here for a lot of reasons. So, Sam, what are you seeing in the copper market? What should people look out for? You think upside, downside, sideways? What are you thinking over 2025?
For sure. I think it's not a great entry here. You are buying the dip, so like that's inherently more risky than buying on strength. But I do see a really constructive setup here. Like in my report, I outlined um, an inverted head and shoulders continuation pattern. Like copper almost doubled off the 2020 lows, and now it's just gone sideways in this consolidation pattern. So I see a left shoulder here, a head here, and then a right shoulder here. So if I think this low from August was a really, really good low. I think you can take a swing against that. I think the market will continue to um, act as support there until proven otherwise. But yeah, I think you eventually get a breakout. I don't know if it's in 2025, but I think it's on the horizon. I think you have a really clear level here at about $5, and Kevin's been mentioning China a lot as a major tailwind or headwind for copper, as they are one of the largest consumers of that refined copper. Um, so China is a big deal, and you did see China outperform the United States in 2024. So trends do tend to persist. I don't know if it'll outperform again in 2025, but I think there is definitely a good chance of that occurring. You have a great bottoming formation occurring there. And I don't mean to get all fundamental on you, but some people are saying that the United States is kind of extended here from a valuation standpoint. But yeah, what do you think about the whole copper story?
No, I'm with you on it. It's once again, it's always dynamic. Like trading is dynamic. You're never gonna know everything on day one. What we can understand is what we should be seeing. And really, to me, like I have a little bit more of a bullish viewpoint on oil and things like copper than Kevin probably does. And that's fine. That's what we do here. Nobody's told to come on here and say this is bullish or agree with Jason. Like that's ridiculous. We're all traders on here. Everybody should have different viewpoints. I even like when you guys out there say like, are you were wrong about this. Like feel free to write in and say, we're right, wrong, crazy ideas. I don't even care. Like I love to hear all of it and I love to chat with you guys about that stuff. But just looking at this whole scenario here, for me, when I look at the commodity cycle, you could have gone back to 2020, and obviously, like in hindsight, it's very easy to say yes, supply gluts, yes, that went on like much longer than people thought at the time, and we could have said all of those things, but really, like a couple factors are just always going to be at the forefront for me as a trader, which is liquidity conditions, the dollar. If I'd see the dollar really start to head down, I would get very bullish on the commodity cycle. The dollar being probably the most important thing that is on in the market this month. Just continue to look at the dollar like this reversal here. That's an amazing reversal. If that continues lower, I would get very bullish on the commodity space as a whole, like right across, almost across the board. Some of these things, of course, they're not all going to move at the same time, but everything is set up well to move right now.
And isn't there some pretty stretched positioning in the currencies? Do you want to speak to that?
Yeah, so I just put a report out. I think that was Friday's report, and if you're on YouTube, it's in the description. And if you go to the description, you'll see the euro is in there, and the euro has pretty stretched positioning, bullish positioning. So basically, meaning the commercials are on the long side, and as they're on the long side, this is usually when we see bounces start to happen. So I think a bounce is probably justified here in the euro, which is obviously the inverse of the dollar. It's over 50% of the Dixie index. And some people go, you shouldn't use the euro or the Dixie index, and you shouldn't worry about the euro. And it's like, no, that's what we trade on, and back testing it works, and the intermarket analysis works. So that's something that we just have to continue to look at. And also it's the world's reserve currency. The dollar is very important to the world. So just looking at those things, yes, the euro definitely could bounce here. I can't see any reason why the euro can't make it up back above that resistance zone that Sam highlighted right there and start to chop around above that zone. And then we can make some decisions. It's just like Kevin said with oil, let's see a close above 75 and then let's talk about oil even more. For me, I'm bullish on oil, but I also agree with Kevin. You have to have price levels that you have to get over to initiate trades for yourself, whether they're not going to be the same for everybody. Why mine, it might be earlier than someone like Kevin's. It's going to change around a little bit. And it's the same thing with the currencies. You're looking at the Canadian dollar here. What a reversal if this all happened right here.
Right on the heels of the president resigning.
Yes.
I hear.
Yes. So the president resigns. We have the basically from the COVID lows. If you look at the Canadian dollar, if you look at the New Zealand Kiwi, you're looking at a lot of these currencies having a good ability to reverse right here. And the euro, actually, the pound, they look better than most of the other currencies. So I think the euro, the pound will probably lead the way going forward. But I do think if we're going to see a real commodity cycle, we're going to see a lot of these commodities, the commodity currencies move up as well. So as currency traders, and Kashop brought this up on the show the other day, he mentioned starting to look. I don't think you have to look as deep as Kashop did, but he mentioned looking into the Latin American currencies and so on, and starting to get into those areas a bit more. I think even the major currencies we're looking at right now, all of those look really good as well. To me, these are very risky for a lot of reasons. The countries, different dynamics. I'm not saying they're bad countries to invest in. I'm not saying I wouldn't take a trade ever in these currencies. I am saying they are getting beat to death a lot more than all of the other currencies out there. So you have to be very careful if you're going to try to trade that. I don't like saying careful in trading, but when it comes to international currencies, when it comes to international ETFs, sometimes I will use that word because you have to really know what you're doing. Because the currencies, if they start to slide at some heavy rate, it can affect your equity positions and so on.
So I like to think of it as large cap versus small cap equities.
Yes,
you can trade an Apple and get pretty close to the benchmark returns, or you can trade something in the Russell 2000 that is going to move 10% every day.
Yes, exactly. It's higher. It's a higher volatility product. The problem that I do see that happens a lot with currencies like this or international ETFs like this is that the crash rate sometimes is pretty massive. Now, so once again, it's just like Sam said, have smaller positions in things like this if you do take these types of trades. Because really, the commodity cycle, if you really do believe corn is going to make a big move, if you really do believe soybeans are going to make a big move, if these things are going to make a big move, the Brazilian real is going to start to move as well. It's just how it always goes. It's the ag cycle. It's part of their exporting process, export and imports, basically globally, supply and demand. Everything's supply and demand. So if we just look at it that way, I would go, yeah, I think there's something to be said about that. But once again, it's a wait for that to turn around because the Brazilian real is in a nasty downtrend. Corn, however, is not. So corn has actually changed trend recently. So it recently made 100-day high. So this is a weekly chart, so it doesn't look as it's not as close up. So if we go to a daily,
it's been a big move. It's almost let's see, since this September low or August, it's up nearly 30%. So
Yeah, I mean it's a huge move for a commodity that nobody's talking about. Nobody's talking about it. Nobody cares about it right now, and that's great. That's good for traders like us. That means it's a position that we can start to look at, continue to hold. We have a position in corn. We've been long corn for a little while now. It's been a very steady position. Most of the time, I look at commodity positions and I see a lot of shakeouts, a lot of volatility. This thing's kind of just been steadily grinding higher. So it's made a 100-day high. It's made it's over the 40-week moving average or 200-day. So 100-day high, 50-day high, 200-day moving average. As we continue to look at all this stuff, I really do think that there's probably some more upside in corn. I think that there's probably some more upside in most of the agricultural commodities, which are going to do very well globally. So, Sam, oh yeah, this is a
Kevin
good
was
one.
talking about cattle earlier. I mean, how can you not mention this? This is what a breakout.
So we've been long feeders for a long time. So we're long feeders, we're long cattle. I like this trade. There's nothing wrong with this trade at all. It's just I don't bring it up much because not many people trade it. Sometimes Kevin and I will have some great discussions about it with you, but it once again I know you guys, a lot of you guys don't trade it, even though you should. There just isn't any ETFs or anything. There's not mini contracts or micro contracts. You're trading the LE or nothing. So you're trading feeders, the LE, nothing else. So basically, I don't talk about it much, but once again, this is something that really does matter to United States citizens. As you go to the store, you buy steak. Kevin brought up a good point earlier. We also are people. Kashop found it kind of funny because if you come from overseas, they don't eat meat to the same as much as we do over here. So if we're looking at all the meat prices kind of rising in the United States, and then the fact that we have friends that work at farms and we can get cattle, we've also done the same thing where we just buy half cow, put it in the freezer, forget about it. And that's great for days like today. We're snowed in the house today, and it's like, well, we're not going to starve. I know that much.
Right.
So I mean, things like that do really help you kind of save money because this is really kind of just moving to the upside again and again. And it's probably not going to stop anytime soon. I think most of the commodities this year, it's going to be a good year for commodities. And part of me is just my contrarian thinking more than looking at the fundamental picture. And I'll tell you guys why. Most of the time when we're looking at fundamentals, they're forward looking. It's the same thing as the Fed's looking at. It's the reason why a couple of years ago they kept saying inflation is transitory. And as they continue to say inflation is transitory, they go, okay, so inflation is transitory. It's continuing to move high. Yes, at that point, it's moving up 200%. And I'm sitting here as a commodities trader going like, okay, why in the world are they saying this? Every day I'm seeing all the commodities move higher. And so all the commodities just continue to move higher day after day. I'm just staring at this and going, why do they continue to say that? And then you go back to the CPI report. And then when you look at that, like it's basically saying there isn't much inflation. They're right, until they were wrong. And by the time they were really wrong and starting to raise rates and inflation is just raging out of control, that's when everybody starts to go, okay, well, inflation's raging out of control. And then the commodities stopped moving up. This is how inflation normally works. And this is how trading normally works. It's why you have to figure out ways to be contrarian at times. So sometimes you have to be like, okay, the price action is doing it. I'm just going to follow it. So, I have a lot of reasons to be bullish on the commodity space right now. But once again, we're going to see. Kevin has an idea. Kevin's very smart. I have an idea. I also feel like I know what I'm doing. I've been trading for many years. So we'll just see what happens. Once again, it's not about being right or wrong. It's about being right big and wrong small. And so with that being said, Kevin is back. So Kevin, you were talking a little bit about cattle earlier. We got on this whole thing with cattle. So what are you thinking in the cattle market? We saw it raging to the upside. I want to ask you, what do you think it's going to do to soybean meal, corn prices? Do you think it's cattle has a lot more upside to go, or do you think it's probably topping out at some point soon?
Oh yeah, so cattle is going to be a little bit interesting. So there's a structural issue. Did you guys go over the structural foundation of cattle markets just in general and why we've seen prices kind of
No.
Tell me about it, Kevin. I want to hear.
Okay, so
We
cattle is
said
in a
Kevin's the fundamental guy. He'll know all the stuff about that.
yeah. So cattle is in a structural deficit right now. Actually, the supply of cattle and how that market has really changed over the last pretty much since COVID has been something that has not really changed. And so what has happened is the cost of trying to raise cattle right now has been so expensive. It's the feed that goes into it, right? Some of it's also grass fed. So, like out here in Colorado, we have a lot of grass fed cattle. But if you're in a drought season, what doesn't grow when you're in droughts, right? Grass and things of that nature. So, and then there's a water issue in a lot of the places that focus on raising cattle here. So what a lot of ranchers did is they said, you know what, screw it, quality over quantity. So that's what you're seeing literally right now, actually the last couple of years, but last year in 2024, it was literally on the radar because instead they said, hey, look, just as an example, I can churn out 100 and raise and sell the market 100 of them, or I can raise and bring the market 60 of them. But if there's 60 quality and they actually are pushing a significant amount of weight, then I'm kind of offsetting, right? I'm trying to expand my margins by lowering the amount of product that is out there, increasing the amount of weight and just weight for cattle, right? So that's basically what's happening. And so that's why you actually have seen prices really stay elevated, just because the market's really not there. And then you also have the concern that the feeder cattle population, which is the smaller cattle, right? The feeder cattle will have some issues and have had some issues when it comes to this influenza situation, H5N1 or whatever we're calling it these days, right? And so if that's going to also be the case, there's going to be a structural demand issue there, and then you can't really backfill. Prices continue to move higher. Dressed weights, though, ripped to the upside last year, like completely bucked 3-year trends, 5-year trends. It was actually very remarkable. So it was kind of the opposite scenario that we were thinking at first, where you would have, these cattle that were getting sick from this bird flu situation. They consume less. They're going to actually have lower weights. That actually was not the case. It's the exact opposite here. Is demand actually going to continue to rise to the upside? That remains to be seen. We will see. You also had cold storage inventories kind of draw to the downside when you're looking at beef as well. So cold storage inventories, lower cold storage inventories, higher prices, higher cold storage inventories, meaning you have more in cold storage, lower prices. So you have several different dynamics that are kind of taking in place here. And Sam can talk about the technicals. You are seeing a little bit of a breakout. I get a little bit cautious. Like technicals on livestock, you can do it, but you got to know what you're doing too. Okay. And I'm not trying to talk down to anybody, but you do have certain contract months that will have an immediate sell-off once they roll. And that's because that's the season to bring them to market, right? To bring product to market. So if you're looking at a chart, just know like some of these massive pullbacks that you've seen most likely are contract rolls and are most likely getting into seasons where you see a significant drop off. So for instance, you usually will see a drop off in production. You'll see a drop off in slaughter literally from Thanksgiving to Christmas. Why is that? It's holiday, right? Usually like you don't have that much activity. What also do you see? An increase in cold storage because you get prepared for those seasons. So, and then what also happens during the holiday season, right? We eat more, right? So like you'll have these weird things where in November, everybody's, people have this November, December holiday trade for it. And it's like, well, why do we see an initial drop off right after the roll? And it's like, because we front load, we could see a front loading of actual inventory before you get to the holiday. And now the big question is, what was the draw of product post holiday, right? And that's kind of the data set that we're seeing right now. So it is seeing actually a pretty decent breakout. And I think that I'm not saying, I don't know what the price is going to be as far as the upside, but I will say the structural support area right now for cattle, if you're looking at LE, is sitting at around 175 cents, right? So that's where I would say support is. Sky could be the limit when you're looking at this as far as resistance. And then hogs are kind of the complete opposite story of that, but we'll keep it on cattle. What do you guys think about the cattle market?
No, it's very similar thoughts, and I like that you highlighted like understanding the contracts. People just when you're trading futures, this is the thing about it. It's not that it's the hardest thing in the world. It's just understanding the structure of it. On here one time, Kevin and I highlighted the fact that there was a significant price that happened at the end of every single month in natural gas. It just was a move up that just kind of was a bump, and it's mainly just because of the roll. And understanding the contracts is incredibly important. So if you are going to start trading futures, please understand those things going forward. I always like to just highlight things like that, just because really, like at the end of the day, like the idea here is teaching you guys how, what we do as traders. We're not giving advice, but we're teaching you what we do so you can create your own strategies, methodology to do it for yourself and protect your own money and make yourself some money. So Sam, do you have any thoughts on the inverse relationship to corn to cattle or cattle to soybean meal? And do you think that there's we're just looking at the charts. Don't even, we don't have to dive into the fundamentals, but if we're just looking at the charts, do you think the inverse relationship has been hanging on, or do you think it's going to change?
Well, you see a lot of times in history that it dislocates. Like there's a tendency to be negatively correlated pretty extremely, but you have seen both rally pretty sharply since that August low. So I think this could last for another quarter or two, but I don't think it lasts forever. And I also noticed I pulled up the seasonality chart. I'm not sure if you could throw that up, or if you have your own seasonality chart. That's
Is it on Slack?
Yeah, I slacked
Okay.
it to you. But
Okay, one sec.
cattle do have a seasonal tendency to get slaughtered, pun intended, in the first 2 quarters of the year. So I think that's definitely something to watch out for. This breakout could be more of a fake breakout, and it could get back in the box here soon. So I need to see more follow through for sure.
You had a question regarding soy meal, though,
Yeah.
right?
Yep.
So you got to be careful with the soy meal trade for this year. Okay, there's a couple of things that are going to be going on. So there's several different crush operations that are being put online here this year. Actually, it's like 9. I think it's like 7 facilities or 9 facilities. I'll get the actual number here for you. Don't quote me on this, but I think capacity is increasing by like 12% or 15% for soy meal crush operations, right? So if you're going to increase the capacity, that also could put in more product into the market, right? And then push prices a little bit lower. So I don't know. I think if you have a chart, you can say, hey, grains are definitely oversold, right? And you have a couple of them that are trying to make a rip to the upside. But the meal trade will be an interesting one because we don't know what the actual throughput's going to be. And we're going to basically figure that out in the first couple of months here. What has been nice about the meal trade, as well as the soybean oil trade, though, is that in Argentina, their labor, their port and their crush labor unions have been striking. It seems like they strike literally like every 30 days, 60 days. So when that happens, you get those immediate spikes in prices when you're looking at soybean meal or when you're looking at soybean oil. And so that could be something that kind of tightens the supply, but there will be, once again, I believe it's 7 facilities being brought to market this year in the United States to increase crush production for soybean meal. And then given that dynamic, and if we're talking about bean oil, the Trump administration basically wants to curb a lot of the biodiesel blends, the incentives for them, the tax credits for them, right? If they want to curb that, then you might also see a buildup within the soybean complex as a whole, because it won't be as beneficial, because without those tax adjustments or those tax credits and for biodiesel, and now we have renewable diesel, I think they call it now. There's another blend that's out there. Without that, then they're gonna have to find somewhere else for this bean oil to go, or purpose for a lot of the crush beans that are out there. That'll be another kind of like a negative pricing pressure that's in the market. I'm not sure if that's already being priced in or not, but that's another item to keep on the radar.
What do you think about the quote that the meal is real, Kevin? You think there's much truth in that? Like the soybean meal tells you about the demand side of the equation more than any of these other products?
Demand as far as like actual consumption here in the United States or globally?
Both.
Yeah, I think you're gonna have to start looking at that more on a global scale, right? Because like you have seen an adjustment when it comes to Chinese imports. So like China's not really importing as much soybeans from us or soybean meal or oil from us. And they're kind of getting more supplies from Argentina and Brazil, mainly Argentina though, right? And so you can't really look at the USDA data on a weekly basis or looking at the port data on a weekly basis in the United States and saying, yes, this really does show global demand or not. I think you're going to have to take it in aggregate of what you're seeing from Brazil, what you're seeing from Argentina, what you're seeing from the United States, and then kind of make that assumption or make that determination there. When you do see imports increasing for soybean products and also corn products, but mainly soybean products in China, that is something to just be mindful of, right? Because it's a major staple. Soybean is a major staple within the Chinese, just for Chinese consumers like yourself and myself. And then also looking at the meal products for their livestock markets is something to be mindful of. But I think you're going to have to take the global totals rather than just looking at it in isolation of what the U.S. is doing, especially if we have a tariff war this year, because it will tell you a completely different story. And you know, I got into, let's say, a back and forth or a debate. It was a good debate by somebody that I do respect in some, you know, when it comes to market analysis. But they were kind of underselling the agricultural impact that tariffs could actually have, or the retaliatory nature. And I think that actually is probably the biggest thing on the radar for China to actually hit our agricultural space, probably first.
Oh,
Because they are
absolutely.
able to back.
Is that a debate? That was a debate?
Yeah, well, basically the debate was Trump's not, you know, the Trump administration is not going to really care because they could provide $20 billion worth of subsidies for farmers in order to offset any type of impact for tariff policy or any type of trade war. What I say to that is that we haven't seen a full recovery from the 2017 war. Right.
Yeah, the subsidies still,
So-
a lot of farmers still lost their farms over
Yeah.
that, and that was still there were still subsidies back then, so it's not
Yeah.
going to be much different this time.
Yeah,
I think
and then
it's just when people have like politics one way or the other, they start to get very they lose objectivism. And really it's like you just have to be objective with situations like this because we're just trying to figure out the markets. I don't care who's in office. I want to figure out if this price is going to move up or down, how it's going to affect farmers, how it's going to affect the economy. Those things matter the most to us, and I think that's what you do very well is always have very objective research, Kevin. So that's much needed in our field.
Yeah, like I said, but so those are going to be some of the things for soybeans. But I mean, you can make a case. Corn's looking like it wants to do something, right? Like it's looking decent right now, and you know, you don't fade the trend. There was the pretty long standing like descending triangle that was kind of taking place with corn, and so now if you're looking at the weekly, going back a couple of years, now they're starting to catch a little bit of a bid. And then you have wheat markets, which looks like it's trying to base out here. I'm surprised. Well, actually, I'm not surprised because I just ate my words there. I was like, I'm surprised that wheat's not actually popping pretty hard today, and it actually is. It's up 2.1%. Actually, wheat might actually be. It might be halted. Wheat
Really?
might be halted. I don't know. I'll have to look. I'll have to look what the levels are. But wheat might be getting close to a halt.
I don't think it's at 3% even though. Let me see.
Yeah, I don't know. Let's assume that it's not halted. Let's even assume that it's still a nice little run today, up 2%. So it's up 2%. Arctic blast could have a shock when it comes to wheat production and have an impact when it comes to harvest, right? So that's a thing. Corn, You could have the weather trade there, but no one really cares until it gets kind of closer to March. And then you got beans up about 1%. So I did have a market that I wanted to talk about, but I forgot.
Well, real fast, let's bring up this chart that Sam brought and take your time. We'll come back to that, Kevin.
Mhm.
I'm sure everybody wants to hear that too. But Sam brought up this chart, and I thought it was kind of interesting. So go ahead, Sam. Why don't you finish on this chart? It took me too long to kind of bring it up.
Yeah, I think this just goes back to what Kevin was talking about and understanding the market you're trading. Markets have seasonal tendencies, and live cattle and feeder cattle tend to sell off pretty dramatically in the first half of every year. And I think Kevin was describing that fundamental reason earlier. Yeah, that's really all I had to say about that.
No, that's good. It just highlights what Kevin was talking about, understanding the seasonal tendency of products, understanding the reason why they have these seasonal tendencies. So we'll go back to Kevin. So Kevin, what were you thinking? One more market from Kevin, one more great insight, and then we'll get out of your hair, guys. Thanks for hanging out with us. Make sure you guys hit the notification bell and subscribe to the YouTube channel. We can talk to you guys on YouTube, answer questions. So definitely check it out.
It was going to be natural gas.
Of course.
So I just want to see what this curve looks like real quick. All right, so right now you kind of have a backwardation of this curve, rightfully so. That's Arctic blast. This backwardation is not as aggressive as the one that we saw last year, right? Which I wouldn't say it was a fake out. It wasn't a fake out. It was the weather trade, and this one's a weather trade. What we are seeing, not the whole move. Not the whole move. The whole move is not a weather trade, but a 10% move to the upside here today. And what we've seen over the last couple of days is the weather trade, right? These weather updates are starting to get a little bit more aggressive, right? But you're not really seeing it across the curve when you're looking at Natty. So just kind of be mindful, be a little bit more nimble when it comes to that trade. For now, I think that's big, one of the biggest things that I was kind of talking about. And then I know Andy. I'll give Andy a shout out because he made this comment last week, and I completely agreed with him. I'm gonna go to another market. I know you said one more, but I'm gonna go to another one.
We have as much time as you got, Kevin.
Yeah.
Whatever you want.
He was talking about the outperformance of heating oil compared to crude, and so one, Andy, you're hitting the nail on the head. You know that we talk about that all the time, and that is something that was a bright spot that we called out last week. It kind of was lagging there. What was it, Friday? I think Monday, right? So Friday was kind of lagging there. Keep your eye out on it. That's going to be once again, I think that's your telltale sign for an actual true breakout. But the resistance for heating oil or diesel is sitting at around $2.40. We rejected it today pretty much at $2.39. And so that's one to kind of keep on the radar here. But if we do see a firm breakout of heating oil, I think that's where you kind of see that continued follow through when it comes to crude. And look, we have 3 more weeks of these elevated prices for all of these commodity products, and then Fed's gonna have a problem for January CPI prep. That's my last thing right there. I mean, you had eggs prices moving to the upside and ripping. I wouldn't fret about egg prices over the long term. Chickens are the quickest reproductive animal that's out there in our staple of our diet as humans. It's the ones that can actually have a very quick snapback. Usually only takes about 2 months, 3 months to kind of replenish a herd that has been completely a flock that's been completely like wiped out because of influenza and bird flu. So I wouldn't get too concerned about it. But when you start seeing the egg prices kind of go up into the stores, it takes a long time for them to come down. You'll start to see some other things kind of creep higher here. Do we see milk prices? No one trades milk. Milk's kind of been ripping higher, but no one trades it. But like milk prices kind of going up, right? Like when you start having that's the stuff that you really don't want to see. If you're a Fed member, you don't want to see utility prices going up because of Arctic blast and seasonality. You don't want to see cattle prices and beef prices kind of going up because of structural supply shortages, because of and this influenza situation. You only see egg because here's the thing about the egg prices part that I think is very interesting. Once again, quickest reproductive animal that we got in our diet, right? But people freak the hell out when eggs prices double, right? And that's when they start to nitpick, and then that's when their sentiment of like, man, I'm seeing the pressures everywhere. I've seen gasoline. I mean, you're kind of looking at crude's up what, 7.5, almost 8% over a week and a half or something crazy like that, right? You see gasoline prices probably a lot more aggressive to the upside. Diesel prices doing the same. Natural gas is just on a tear, just in general. That's when you kind of get that sentiment to kind of shift. And Jerome Powell has this narrative, or his thought process. He brought this up early last year, and we talked about it. I was making a joke of it, where he was like, "Well, if people believe that inflation is going to come down, then inflation is going to come down," which is actually one of the most craziest things. And maybe it's true, right? If you can see it, maybe you can achieve it. I think R. Kelly said that. Yeah, that's not a good reference, I don't think. But let's see. Look, if that is going to be the case and people start seeing these products kind of going to the upside, we already know what shelter's doing. We already know what insurance is doing, but you're starting to see some of those things that people really hate seeing going up. I think that's where you get the sentiment shift in the market. And that's where you kind of have that problem when it comes to the inflationary narrative. That's where you kind of see that 10-year kind of seeing some pressures there. So a 2-week spike, 3-week spike for energy prices, and for them to come down, really consumers don't typically see lasting pressures of that. It's when you have a month and a half, 6 weeks, 7 weeks of prices, that's where it becomes a little bit more sticky.
No, that's a great point and a great thing to end on, man. I love what you said there. Always great having you on, Kevin. Thanks for making the time. I know it was in the middle of your day and all your hits today, so thanks for coming on. Sam, as always, thanks for coming on. And you guys, I really appreciate all the support lately for the channel. You guys have been very attentive writing in. And please write in to Kevin or me, hit us up on Twitter, hit me up on email, Substack, however you guys want to do it. We will try to answer your questions. We'll bring your questions here. We'll answer them live in front of everybody. Also, if you guys are on YouTube, you guys have direct access to us to ask questions. And the link's always on my channel on Twitter and on my channel, obviously, at YouTube. So thank you guys for joining in. We'll see you guys soon.